Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us today. It's great to have you all with us. Our goal with FounderLine is to provide a way for people who have questions about startups to get them answered by experienced entrepreneurs and investors. Maybe you're thinking about starting a company, maybe you've already started a company and you're encountering a situation that you need some help with. Maybe you're thinking about joining a startup and you want to know what it's like to work at a startup company. For any of those situations, we want to try and help you out. The only way we can do that is, this is a live show, and so we need to hear from you. We need to have you send in your questions, and we'll do our best to try and answer them. You can email us. The email address is help@founderline.com, or you can tweet at us. The Twitter handle is @FounderLine. With that, let's get started. Our guest today is Dave McClure, who's the founding partner of 500 Startups, a truly global seed fund and startup accelerator based in Mountain View, California, with offices also in San Francisco and
Mexico City, and also Taiwan, soon Korea, Singapore.
Offices everywhere, everywhere.
A couple places.
So he and his team at 500 Startups have funded over 900, so I don't know when the name change is coming, but hopefully soon, across more than 50 countries, including Twilio, SendGrid, MakerBot, and Wildfire Interactive. Dave, welcome, and thanks for joining us today.
Thanks for having me.
How you doing?
Good.
Yeah, you look exhausted. You just got off a plane, I know.
Not too long ago. I was in Miami on over the weekend and just came back on Sunday.
Tanning yourself and.
Not really, although I did get to hang out at the pool a little bit. But
Awesome.
We were hosting a conference there on venture capital changes.
I saw that. I saw Sooster like meerkatting.
Yep.
Like to the audience. Is that what was going on?
He was Skyping in and then also meerkatting from where he was.
Oh, got it.
Which was kind of cool.
That was funny. Yeah.
That was
We tried to meerkat the show last week, and it's just so bright in here that the iPhone could not handle the
You look very pasty, I bet.
Yeah, we were kind of glowing. People told us, but anyway, before we chime into with questions from the audience, we usually spend just a few minutes chit chatting and getting
Sure.
to know our lovely guests. So I know you're incredibly busy, so thank you for being here today. You're also, judging by the airplane on your shirt, you're always on the road. So I really want to know how many frequent flyer miles you racked up last year. Do you know?
I didn't count, but I'm guessing around 300,000 miles or so.
Wow.
So probably was traveling about 6 months out of last year, and I was probably in the air 100 days last year.
That's nuts. So do you never see your family?
I do see them occasionally. The kids sometimes recognize me.
That's really tough. I know. I don't know that travel schedule, but I know what it's like to try and be there. And a lot of people talk about 500 Startups versus some of the other investors in the Valley, and you guys have really taken this global approach. So love it if you could share some thoughts on why you decided to do that and what's been happening with that approach.
Well, I think we have a big belief that there's going to be a lot of growth outside the U.S. That's already happening, but certainly over the next 10 to 20 years, most of the growth in the world is probably happening in other places. Asia, Latin America, Middle East and Africa, kind of primary geographies. Also, a lot of it is kind of because we can. I think, maybe prior to 5 or 10 years ago, really prior to maybe 3 to 5 years ago, there just weren't as many large online populations. That's really dramatically changed in China already. It's changing now in India. So you have, billions of people coming online that weren't there before. There may be still some challenges in monetization and payment, but those are getting solved soon. So there's just really, really big markets that weren't accessible before, and they were also very expensive to build for prior to maybe 5 to 10 years ago. But now with the cost of software development coming down, the ability to reach customers online and improve payment, monetization, logistics, really, the world is flat. That actually is very true for startups. And so we can do things that we wouldn't have been able to do 5 and 10 years ago. But it's still, there's lots of cultural issues, language, sometimes regulatory and other issues to get around. And most people just don't want to try and do a global play, at least at our level. It's very challenging to do seed stage investing globally.
Wow. And so I'm guessing most of the companies you fund are here in the States, but an increasing proportion, overseas?
Yeah, so about half of our investments are actually in the Bay Area and Silicon Valley or come through our accelerator program.
Okay.
Another quarter, maybe our rest of US, another quarter are international, but the international component is rising. About a third of our team is outside the US, spread across 10 to 11 other countries.
And those are employees,
Those are people who work for us.
Okay.
We have about 50 people on the team. About 16 of those are making investments. But,
wow, amazing.
Team speaks 20 different languages, and we, really intentionally trying to, build a network globally and have reach in lots of different tech metros around the world.
That's awesome. That's
well, it's awesome if it works. We'll see.
Well, we will see. And you guys, I mean, you're a 5-year-old startup yourselves, and I know, with any startup there are ups and downs. So, in that time period, like what have you learned about the market, yourselves, the team members? Like, share some thoughts about that.
Yeah, I mean, I kind of think that we're maybe somewhere in between a Series A and Series B startup. We're we're about 50 people. We have about 10 million in revenue. Hopefully, we're profitable. I think so. And we've been growing maybe about 50% per year. I don't know if we're growing at 100% like typical Silicon Valley startup. We're a very spread out organization, so a lot of communication challenges based on time zone and language and culture, the same way we were just talking about.
Yeah. What'd you do about that? Like, how do you?
So we have been using, recently we're starting to switch over to Slack, but we've been using WeChat kind of to keep in touch with people on our team, which is a little unusual. I don't think most companies in Silicon Valley are used to using WeChat.
Yeah.
And we also get on the plane and fly around a lot. So a lot of times I'm visiting other teams and people in the different geographies where we're present. But there's still challenges to that. Contrary to most people's understanding of venture capital, we're not particularly rich, or at least we didn't start out with a lot of capital. So we really kind of bootstrap the fund. I made a little bit of money at PayPal, but not a lot. And so getting the fund raised and getting enough kind of operating budget, we had to be very creative in how we operate. Most funds our size are, most funds that operate the amount of capital we operate are about a third or less the size of us. So we operate a little differently, maybe.
Well, and I imagine that's really helpful on the investing side, because you have just lived through and are living through what a lot of your startup companies are going through, right? I think we relate well to our companies. There's probably a few companies that we invest in who actually pay themselves more than we do. We're modestly comfortable, but I think we're pretty inexpensive compared to the Silicon Valley VC standard. Yes, you don't have real estate on Sand Hill Road, I've noticed.
Yeah, I'm not playing a lot of golf in the country clubs. Maybe.
Yeah, maybe playing a little ultimate, but that's about it.
Indeed.
Okay, and then finally, you guys have these two components of 500 startups, which are the seed investing side and then the accelerator.
Right.
And I don't know which term you guys like to use, but maybe talk about how those two play together and,
sure.
and are there different people working on them, same team?
Yep. Yeah, so we started out doing seed investing when the firm got started. I had been doing seed investing actually for Founders Fund, and I'd been doing it as an angel before that. But I really loved the idea of running an incubator program or accelerator program. I'd watched a lot of what Paul Graham had been doing at YC and a lot of what David Cohen and other folks had been doing at Techstars.
Yeah.
And really even before that with earlier programs like Garage and Idea Lab as well. So I kind of got a taste for it. I got to run the Facebook Fund program for the summer 2009. You came over and did some talks for us, I think.
That was fun. I think that's when we first met, actually, was in the old
Yeah.
Facebook building there.
Right. So I think I got to teach a course at Stanford in 2007 that was kind of around building Facebook apps, and then that experience in 2009, and really loved the idea of trying to build a program that was kind of resident with teams and companies kind of coming in together as a cohort. So after we got the fund started in 2011, we did our first small batch in January, I think, of 2011. It was still pretty rough. We were trying to figure out what the structure would look like.
Yeah.
We did a small group of maybe 10, 12 companies. The next one we did about 20. And then the third one really kind of tried to expand to 30, and that's kind of been the size we've been operating with.
You keeping it around 30 now?
Around 30 companies, about 75 to 100 people. Along the way, we had invested in an accelerator in Mexico, Mexico City. Later, we kind of brought that under our kind of umbrella, and so now we operate that program in Mexico City for Spanish-speaking companies. And then we also opened an office in San Francisco about a year ago and started running a program there, and now we kind of alternate in the Bay Area.
So like every 6 months you're switching between them, or?
Actually, every 3 months we start
wow.
a new program. So right now we're wrapping up San Francisco batch in the next month, and we're starting the Mountain View batch a little bit after that. But we're doing probably about 120, maybe 130 companies a year through those two programs, and another 30 through Mexico City. So
Wow.
So we run probably, last year I think we did about 300 investments, about 150 through our accelerator programs, and then 150 through seed stage, which is a little weird because we actually, we kind of compete with maybe Y Combinator and Techstars and AngelPad and others, but we're also investors in their companies as well. We've invested in probably over 80, maybe close to 90 YC companies. We're actually investors in AngelPad, small investor in their fund. So we're pretty collaborative in that we want to work with great companies, and some of them will go through our programs and some of them will go through others.
That's great. Well, why don't we see if we can help some people out?
Sure.
So let's let me go in here and check the questions. I'll just remind everybody, you can reach us either on Twitter at FounderLine, or you can email us to help@founderline.com. So let's go to the first question. This one is from Michael. Why is it that so many people who worked at PayPal went off to found companies like Tesla, YouTube, LinkedIn, Yelp, Yammer, and 500 startups? How was PayPal able to hire such great people? What did you learn there? It's a great question. I mean, there's so much legacy from that
There's a lot
PayPal
of
tree.
really amazing people, of which I'm not one.
Come on now.
Well, I'm working on it, but I mean, certainly Elon with Tesla and SpaceX, and Reed with LinkedIn, and David Sachs with Yammer, the YouTube guys, Yelp.
You're not going to Mars anytime soon, or?
I'm not going to Mars, and then also on the investing side, so you have like Ruloff at Sequoia, obviously
Grabwa.
Peter at Founders Fund, Reed's at Greylock, Keith's at Khosla. So I mean, there's like a lot of people at really well-respected VC firms as well. I think there are two things that really led to that. One is it was a very competitive environment for PayPal. I mean that in a way that it was not an easy road in a lot of ways. There was a lot of growth going on, but a lot of challenges. If you kind of look at maybe three companies that I think were always having to change and innovate and kind of move very quickly, I would say Amazon, PayPal, and Facebook were kind of at least under threat to try and figure out the business model.
Yep.
Whereas if you look at maybe Yahoo and maybe Microsoft and Google, all kind of found their business models relatively early and really didn't have a lot of competition. It seems like there became more competitive elements that came out of those companies that didn't find the business model early and were under threat and had to keep innovating, as opposed to found it really easy. But I think the other reason, which I think is less talked about, is PayPal raised a lot of money. They were kind of in the late 90, early 2000 period, and then they merged with X.com.
Right.
And then they both raised a lot more money together, and there was just a ton of dilution. And so when the company went public, I think Elon had about maybe 13%, and Peter had about 6%. but Max, who was one of the founders, I think maybe only had a couple percent.
Oh, wow.
And so outside the founders, there really were a lot of senior level folks who didn't actually own that much of the company. And so when it went public and even after it got acquired by eBay, some people made some money, but I don't think a lot of people made as much money. I think there were, probably very, I don't want to say low level people, but people who were not very senior at Google and Facebook and other places who made a lot of money.
Yeah, well, there's the canonical, the Google masseuse or chef or whoever, right, who made tens of millions of dollars, right?
And so I think there were a lot of us at PayPal that maybe were there for 3 or 4 years, but didn't make billions of dollars. We maybe made hundreds of thousands, or in some cases, single-digit millions, which sounds like a lot, but in the Valley, you can find $1 million gone like that.
Yeah. A shack in Palo Alto.
Yeah, so I think there's a combination of this, very competitive and fast-paced environment where people had to respond. So obviously some really smart people from U of I and also Stanford and other places. But I think a lot of it was that people, kind of realized and turned around after they kind of won. They didn't really make a lot of money and people were still hungry. And so a lot of those folks were like, well, shit, I really, I want to have a big win and benefit from that. And people like Reed and others kind of, went out and, did that.
So who made all the money on PayPal? Was like were there two big investors who
I think
made
it
everything?
Was probably Mike Moritz at
Sequoia. Okay.
I mean, I'm sure there are plenty of others that I think also. Nokia, which I believe now Blue Run is the entity, and a few others.
Got it. So the investors had like way more than 50% at that point, or something.
I think quite a bit more than that, and really Max made decent amount of money, but I bet you Max probably made as much or more on Yelp as an investor than he did in some of the other things.
Well, we'll have to ask him next time I see him. Well, Michael, great question, and a great legacy for that company, which obviously is still going strong. So let's move on. We've got a question here from Alex. It says, "I've heard that you decide to invest very quickly. What do you look for when you invest? How can you make the decision so quickly? What advantages, disadvantages do your investment techniques have over other investors?" And I can chime in on this as well, since Dave and 500 funded Tello when I was running that. So go for it.
We have a really basic investment thesis, and a lot of that is that we want to invest pretty early, really at, kind of in a phase that's not idea-based. We really usually like to invest after the company has a functional prototype and some early customer usage, but not that much. So in a lot of cases, we might be investing in companies that are maybe only making $5,000 to $15,000 a month, maybe a little bit more than that in a few cases. But if we like sort of the basic concept, we like the initial product implementation, and there seems to be early, usage by customers, a lot of times we'll make the investment, knowing that maybe only a percentage of those are going to get to a later stage growth or investment, but we'd like to be in early as possible in many cases.
Got it.
So, I think there's a tradition in history in venture capital of doing a lot of due diligence and really trying to find out as much about the founding team as possible. But I think that's kind of misplaced in a lot of ways, particularly with companies that are very early on. There's just not that much to look at. There's maybe not a huge amount of balance sheet or revenue to understand.
Yeah.
You could maybe do some customer interviews, but it's probably still pretty early in the product evolution. And I think a lot of investors place a lot of emphasis on the team and the people when it's really a very subjective assessment, and they just don't know the people that much in most cases, unless they've already been investors maybe in previous companies.
Yeah.
So in our opinion, obviously team's really important, but we look at product being kind of the mirror into the soul of that person or that team. We look at the customer adoption as really a validation of whether that product is good. And so for us, a lot of our decision making is looking at the customer numbers, looking at the product experience, kind of seeing if we think that's interesting, and then writing a small check. And then really over the next 6 to 18 months, seeing if the company can progress on progress, and writing a second check. So in a lot of cases, our due diligence happens after we write the first check, and up and through the time when we write the second check, which might be a year later. But I think just in general, having a very large pool of diversified investments is what makes our strategy work. We probably have 10x to 20x the size or portfolio of most other traditional VCs. And I think there's not very many VCs who, with concentrated portfolios, are consistently able to produce winning returns. That's just, I think in the industry of VC, probably 1 out of 4 VCs actually beats the risk-adjusted return of kind of a 10-year illiquid fund. And my guess is probably less than 5 to 10% of those do it more than 3 funds in a row. So I would generally say that people who have concentrated strategies are the ones who are gambling, and I'm having more of a quantitative and diversified approach to investing, which, in the Wall Street world, mutual funds and index funds, that's a widely accepted, and more thoughtful practice. It's only in Silicon Valley that we somehow think that having this large diversified portfolio is kind of like, I guess what they like to call that spray and pray is kind of how most people look at what we do. But anyway, we think it's just a much better approach to investing, and it allows us to be much more aggressive about the things that we're doing, both in terms of scale and quickness.
And so those initial checks, are those typically 50 to 100K?
Typically 50 to 100K.
Okay.
And our follow-on investments, when we do them, probably between 100 to 500,000.
And those are pro ratas for when they do this? Or you might just come in and
we don't really like the word pro rata. We think that actually, we want to be either greedy or not about, the opportunity to invest more capital. So ideally, we would like to gain an incremental 50 to 200% ownership or more if that's possible. Rather than pro rata investing typically is most cases not more than 20 to 30% of existing ownership. So I think traditional VCs tend to write a first check that's 20 to 30%, and then they can't really invest double that. That would not be very possible or likely. In our case, we're typically investing maybe only between 1 to 5% on the first check, and so it actually is possible for us to double
scale
ownership.
Got it.
Anyway, that's
cool.
just our philosophy.
All right. Let's see. So thank you, Alex. That was a great question. We have a.
By the way, I just want to say, there are disadvantages and advantages to that approach. So a disadvantage is we probably don't ever get to take board seats. We probably don't get really large ownership positions in our big wins. But the advantage is we have a very large network of companies and founders. And the other advantage is we can do crazy stuff like investing in other countries because we have a large diversified pool.
Cool. So here's a tweet that came in from Billy. It says, Dave, are you spotting Southeast Asia too? So I'm not sure what that means, spotting Southeast Asia. Does that make sense to you?
I guess, well, we have a team in Southeast Asia. We have a fund in Southeast Asia. The partner who's running that fund is Malaysian, and we have some other folks on the team in Indonesia and Singapore. And we've made investments, I think probably 30 or 40 investments across the 6 countries in the area. Southeast Asia is a really vibrant and growing, economy or economies. Probably about 600 million people. Really large opportunities in Indonesia, in Philippines, in Thailand, Vietnam. So we're really bullish on that, set of markets, and we, have even dedicated a fund to go after that.
Maybe that is Google Translate turning. Are you covering Southeast Asia? Maybe that's.
Yes, we definitely are, and one of our top regional geographies.
Cool, thank you, Billy. This email is from Jimmy. You've invested in hundreds or thousands of companies. What is the number, by the way? I saw 800. I saw 900.
I think we're actually over 1,000 right about now.
Oh, really? Oh, you got to update your homepage or whatever.
Yeah, we're not really trying to keep track of exact numbers, but
I remember when you first announced it was 500 stars. Everyone's like, "Oh, that's crazy! He'll never get to 500." And we're only 4 or 5 years later, you more than doubled that. That's pretty amazing.
Well, I think it's a little crazy when we got started. Looking backwards, it's kind of you make progress.
Maybe it should have been 5 million startups.
We're working on that.
So he says, you've invested in hundreds of thousands of companies. I'm curious if you could break down how many are dead how many are doing okay, doing great, and then have achieved unicorn status? Thanks. So I don't know if
Sure.
you give that info out publicly, but
Yeah, well, we kind of do. I would say one definite unicorn so far, which is Credit Karma. We know that one's valued at more than $1 billion.
Wow.
A little bit unusual because we came in maybe at a higher valuation than normal. We actually invested when it was about a $60 million valuation, although I had actually done the original investment when I was at Founders Fund at only, I think, around 5 or something.
So you knew them from that?
I knew the founder pretty well. The other one is, that I think might be there, I'm not quite sure, but Twilio is probably close. I think they were, from a year and a half ago, maybe halfway there. And they've certainly been growing since.
Okay.
And again, that was a company I had invested when I was at Founders Fund, but then also we did out of 500 startups. So I think at least 1.5 unicorns, maybe.
We'll call it 2. There might be another one in there you don't know of,
Right.
A mini unicorn.
I think we define this term called centaurs, which is $100 million companies.
Okay.
And
Centaurs. I
cent 100.
get it.
Anyway,
Get it.
so
I was going with the visual, but half man, half whatever, right?
Right. So I think we have probably at least 20 and maybe 25 of those right now.
Wow.
We think we have a lot more coming. On the dead side, I would say somewhere between 300 or so that are officially dead. Maybe another 100 or so we're not quite sure about. But
They don't know yet if they're dead?
they might not. I'm not
I call
trying to be
those
too
zombies.
morbid.
I call those companies zombies. I've had a few.
We sort of predicted about half of our portfolio will go to zero, maybe even 50 to 60%.
Wow.
We think we will get some kind of exit from between 20, maybe up to 30 or 40%, but I think probably somewhere between 20 to 30%. I think that we will get large returns, and I would say 10x or better returns from probably between 5 to 10% of portfolio. And those 20x, 50x, even 100x, they do occur, but they're probably more like 1 to 2%. So it's very asymmetric on the outcomes. Obviously, we'd like to get better, or we'd like them to get better. I don't know which is the story.
Yeah.
But I think we expect half of our investments to go to zero. We expect probably another third or so to not be really material.
Yeah.
So it's really concentrated in maybe that 5 to 10%, maybe a little bit more.
That's cool. It'd be interesting to see the visual on that at some point of like the amount of money that created, $10 million in return or whatever, for.
I mean, some of the, I made an investment in Zimride, which became Lyft, and the initial investment I think was done at a $3 million valuation. It's now at a $3 billion valuation.
Yeah.
So occasionally you do see kind of those 100x, even maybe 1000x kind of stories, but they're few and far between.
Awesome. Let's see. So this is an email from, it's either Karan or Karen. Dave, how do we get into 500 startups? We've applied for the upcoming batch. Any tips on improving our chances of getting in? P.S. We make marketing automation software for SMBs, blah, blah, blah.
Okay.
So,
Did they say whether they had a shipping product or revenue?
Over 12,000 SMBs using our product will go paid in 30 days. So it sounds like lots of
Not
free.
paid yet.
Yeah.
Okay.
Yeah. So
That's probably one that we would like to look at. I have a feeling we would probably want to wait one more cycle to see what their conversion to paid looks like.
anybody's paying.
Unless it's obvious. I mean, if they got 1,200 customers.
12,000.
12,000
Yeah.
users.
Free.
Okay, and then depends on what the product is and how much they could get out of that. Like I said, most of the companies that we accept into our program have a functional product and actually have revenue. Maybe a few of them aren't revenue oriented. But it's not unusual for us to have companies that are doing 100,000 in revenue, in some cases even up to $500,000 or $1 million in revenue. It really helps a lot to know other people in our network, particularly other founders and mentors.
So like if somebody comes to you and says, hey Dave, there's this great company, that works really well?
It does help. I'm not saying that that's going to immediately mean that they're in, but probably if we get an endorsement from, particularly at least 2 or 3 people that we know, then that helps a lot.
Got it.
So if you already have access to 2 or 3 people in our network, definitely use that. If you have KPIs that are working, then that's kind of where, and I would say working for us means probably in the 10K per month sort of range.
Cool. Well, Karan or Karen, good luck, and hope you guys get in. Hope that's helpful. We are going to take a little break here to pay the bills. So relax, have a frosty beverage, and I will take care of business here. So we want to be sure that we thank our 4 amazing sponsors. We couldn't do this show without the support that we get from them. Oric, Square One Bank, Accretive Solutions, and Ustream. And so I'll start off with Oric. I've been working with Mitch Zuckley and his team over there for many, many years. And I always tell people that when you're doing a startup, it's really important not only to have a lawyer who can do the legal paperwork for you, the financings, the employment agreements, whatever, but just someone who can be a great advisor for you, who's seen hundreds, maybe thousands of transactions, and certainly thousands of employees hired, and can help you out with what they know because they've been through it, so many times before. So make sure you get a great lawyer. Oric is one of the best, and I highly recommend them. You can find out more by going to their website. It is oric.com. Next, I'd like to thank a new sponsor for us this season, I should say, which is Square One Bank. I've known the team over there, Lori Lumenti-Gardi and Sam Baumick, for many years, and have worked with them on multiple companies. And when you're building a startup, you really want to have a great financial partner. Not only do you want to make sure your money is safe, which is true of any bank, but you also want you might need some advice. You want them to make your life really easy with things like online banking, or another great example is a company credit card. A lot of times founders end up putting all these expenses on their personal cards, and then someday bad things start to happen, and all of a sudden they have all this credit card debt that they need to clean up. So make sure you work with a great bank, and I can vouch for the team over there at Square One. You can contact Lori to find out more, or go to squareonebank.com. That's square with the number 1 bank.com. We also have another new sponsor this season, which is Accretive Solutions, and they are the leading business outsourcing firm in Silicon Valley. I had to ask, what exactly is business outsourcing? It's one of those nebulous terms, and really, it's your finance function. So they act as your temporary CFO. They'll be your controller, pay your bills, accounts receivable if you have money coming in. And I've known the team over there again for many, many years. You see a trend happening here. Martini Ni Gonal is the person who I've worked with multiple times now, and she was my interim CFO at Tello, and is now helping us out with FounderLine. And you just want to make sure that let's say when an acquisition comes, one of the biggest problems startups face is getting all their books cleaned up and making sure the assets and everything else is lined up. So they'll take care of all that stuff for you, so you can focus on, growing your business, which is the most important thing that you need to worry about. You can find out more on their website, which is as-bos.com. That's Accretive Solutions-Business Outsourcing Services.com, as-bos.com. And then finally, I'd like to thank the Ustream team. We're bringing this live to you over Ustream right now, and Brad Hunstable and the team have been with us since day one. They were one of the founding sponsors and have been hugely supportive, helping us to grow FounderLine into what it is today. Their streaming technology is the best, and if you're a company and you're looking to stream some meetings, or maybe do some company events or whatever it might be, Ustream can help you to do that. So if you need more information, you can go to their website. Their website again is ustream.tv. So that's paying the bills. Hopefully those companies will be useful to our startup founders out there. I'm going to throw you a total softball. So what's a question that you wish somebody out there would ask you, and nobody ever bothers to ask you? I'm sure you get lots of questions that are the same all the time, but maybe something that's misunderstood about 500 or you or whatever else. How's that for a transition? And we got a bunch more coming in as well.
Well, usually I get asked by people like, how do I get into 500 startups, or what's the best way to pitch you, or something like that. And I'm kind of like, actually, like, a great question would be, how do I help protect you from aggressive founders who are pitching you in bathrooms and other places that are really awkward and very uncomfortable?
Yes. Well, so what's the answer to that?
I think a lot of times when I go on trips, there's somebody who's helping me in a particular country to, really figure out what's going on or help manage going to events. Usually that's kind of my Sherpa in wherever I'm going.
Your body woman or man, as it's called, right?
Yeah, and they're typically someone that I really place a lot of trust and faith in.
Yeah.
Maybe too much sometimes. So those people are really great, and I've had the good fortune of just really meeting some awesome people all over the world. So those are really great experiences, and a few of those people, I guess, I eventually get to know. Although sometimes people will offer that, right? It's like, oh, Dave, I'll help you get into this country or like take you to these places, which is really a very long captive pitch sometimes.
Yeah. That's
so you kind of have to be a little careful about how that all works.
So you may not know these people, and they'll say, come to India, and we will, take you around to various companies or whatever.
Yeah, I mean, I think at this point we know people in a lot of places, so
Okay.
we do have ways to kind of vet and check that out. Usually the people we work with are people who are already organizing events on the ground and already have a pretty large and visible network. But every once in a while, we run into kind of some
stalkers
situations.
So how do you handle that? Like, how do you? I'm sure you're like, hey, I'm exhausted right now. I'm walking back to my hotel room right now. Like, you're in my bathtub. Like, I need to go to bed now. Get out of here. Whatever.
I hope that's not the case.
Okay.
I mean, we try and be gracious. People are obviously trying to work hard in their startups, and I think we're we're in the business of trying to find great companies, and so we do want to hear about those companies. But sometimes it can be a little exhausting.
Yeah.
Particularly if you're at a public event or speaking or something, and just a bunch of people continually come up to you and just continue to tell you everything about their world. And so I don't know. Every once in a while, like I'll be someplace. I was at a dancing at this club or something, and it was like 10 o'clock or 11 o'clock, and someone like comes up and starts trying to pitch me on the dance floor, and just like, I'm like, really, dude? Like, not a good time.
Yeah. You're like playing Ultimate, and like someone runs out on the field.
That's okay,
right?
but I mean, I have been pitched in urinals multiple times.
Oh yeah.
I've been like 2 in the morning trying to buy something at a convenience store and go to bed, and this guy's like pitching me at like 2 in the morning. I'm like,
the clerk at the convenience store is like, hey, I've got a startup idea for you.
Anyway, we try and do, be gracious, I guess, if we can be.
That's who you are. So, I'm sure like Mark Cuban goes through this as well, right?
Yeah, and I've seen, Ron Conway and Mark Suster, just incredible amounts of patience sitting and listening to companies for hours. I'm sometimes not that patient.
I think you do pretty well. All right, well, let's see what else we got here. So this one is an email from Larry. He says, what benefits are typically offered to or expected by employees, presumably in startups? Do the benefits change as the company grows and matures, or is early stage company expected to offer benefits comparable to a mature one? Do stock options replace or supplement a 401k? So pick anything out of there on the benefits side.
I think when it's just a couple of people getting started, it's maybe hard for them to offer a lot of benefits, and usually the founders are giving up some of their, market rate compensation to keep the company expenses low in the beginning.
Yeah.
I think that, there's gradually, as you get to 5, 10, maybe 20 people, you start to have traditional benefits and programs that are offered at other places. Some people do that right away. I mean, they may raise $1 million or $2 million. They may try and be competing on market rate salaries right away.
Yeah.
And they may use, stock-based compensation as a way to offset that if they don't have, maybe completely market rate salaries, or they're trying to, incentivize people to stay there. I think there's just a balance of what you think the people in the company need, and as you gradually add employees that maybe have very commonplace needs. They may have kids, they may have families, they may have mortgages, they may most people need health insurance. Some people also want other benefits, so dental and vision and even disability and 401k plan maybe.
Yeah.
So I think you got to figure out what kind of company you want to be and whether you want to be competing with everyone on those market standards, or whether maybe you could be a little bit scrappy, not maybe on the health insurance perhaps, but on maybe some of the other things.
Yep.
I think there is some trade-off with stock-based compensation and cash or other benefits. Certainly in the first year or two, I think the company maybe is trying to get to some level of stability and maybe hasn't raised a lot of capital. Maybe after year two, certainly after they've raised at least a $2 to $5 million round, I think there's probably expectations that they are at least not making it hard for people.
Yeah.
But it is really challenging when you're in the Bay Area. There's companies paying people $250,000, maybe $500,000 for really talented people, and I think competing just on cash is really not a good strategy, I think, for startups. I think you have to compete on mission and purpose and sort of culture. I think that's really where maybe people will defer having a lot more cash, and maybe they'll work harder for a couple years in a company where they really feel aligned with the purpose, or the culture is really welcoming for them.
Well, and the people who are really focused on the cash, like my bonus was X at my last company. I realize you're only 4 people, but I need you to match that. Like, probably not a good fit for a really early stage startup anyway. So
I think whenever we hear the words "I need," that's actually not a great sort of fit for a startup.
Yeah, exactly.
I think that's just not a great place to start when you're sort of stating. I mean, I understand that when people have family or kids or mortgages, there are certain needs that they have.
Right.
But I think they also have to recognize that if they are joining a startup,
it's trade-off.
There's going to be a trade-off in expectations and comp and cash. Hopefully people understand that trade-off. Hopefully the founders also understand what they're asking of some of those employees, and that they are kind of treating them well and rewarding them for the work, in many cases the hard work that people are putting in and getting startups off the ground.
Yeah. Are you guys now to the point where you could, as 500, offer benefits like, I'm not saying you want to become a PEO or like a TriNet or one of those guys, but do you do anything on that front, like because of the buying power, right?
Right. Yeah, we have a set of services that we try and offer to all of our portfolios, sort of like I don't want to say it's a co-op, but we have a large group of companies now. So we definitely get credits and benefits from companies like Amazon or Rackspace or others.
Got it.
I don't remember if we actually have put together health insurance plans or benefit plans. I don't think we've done that yet, but we could.
Kind of a different business to be in, but
yeah, I mean, and we funded a few companies that are in those areas that kind of do a lot of that. I think we are getting to a size now, probably, depending on how many of the investments feel that they're 500 affiliated versus, they've just got money from us. We do have thousands of, founders, just founders.
Yeah.
Employees, probably tens of thousands, if you consider all the companies. So maybe we should start thinking about some kind of HR benefits.
Yeah, no, I mean, you're the size of a small nation of some sort now. So
not yet, but maybe someday.
That's cool. All right, so here's one from Daniel. I don't know that I think this is true, but there seems to be some bad blood between you and Y Combinator. Is that true? Are the accelerators and incubators really competitive? So did you get in a fight with somebody recently that I don't know of, or
there was a small Twitter flare-up between me and Sam about something that I don't think it was really a big deal. Sam noticed that I was in Miami or something and
drinking cocktails.
Offered a suggestion that maybe I should stay in California more often. And
does he know you?
Well, I mean, I guess some people may think that I get on a plane and all I do is go to nightclubs and dance and hang out and eat lots of food. And actually, you spend a lot of time traveling. You spend a lot of time switching time zones. Usually, we're either fundraising or we're recruiting people for our team or for companies.
Yeah.
or we're doing talks and conferences. So, and at the same time, I think, we have about 50 people in the company in 12 different countries, and we are supporting our companies in different ways. The reason I was in Miami and the reason before Miami and Mexico City was, we've been trying to expand our presence in Latin America and reach out to, a 500 million person market that has lots of startup potential. So
yeah.
I might kind of suggest to Sam that maybe if you want to increase your international reach, you might need to get off your ass and actually go to some of those places.
Snap.
But I think Sam knows that, and there are other people at YC who are doing that. I have a ton of respect for YC and what they've built. I really, not at all to crib on what they've done. They started a lot sooner than us. They've had a lot bigger wins than us.
Yeah, in fact, you cited them as an inspiration for why you even started to do this, right?
PG and Jessica and other people at YC were some of the reasons that we started, and I've invited them to speak at numerous events that we've done. I think what probably is happening is we're getting a little closer and maybe a little bit more competitive than. I think it's easy to be gracious when you're crushing it and nobody else is close to you. It's maybe not quite so easy if you see people starting to catch you. But like I said, we've invested in close to 100 YC companies. I think we're either number 1, 2, or 3 in investors who are most frequent investors in YC companies. And so there's a friendly competition, I think, but hopefully that's not really aggressively negative. I would say frenemies. Let's call it that.
Well, so I heard from they just had YC demo day, and you were there, and I was talking to one of the companies, and they get some good data on like who has hit the like button and whatever, and one of the companies got like an investor liked like 105 or 110 companies. And he's like,
a little too.
Yeah, I'm like, that guy's just hitting the like button for everybody. You do not waste any time on that one. Like the person who liked 5 or 10 or maybe 15 companies, they're out of 100 and whatever, right?
I think I probably liked about 15 to 20.
Yeah, I mean, like that's who you want to talk to. They're just dialing for dollars, right?
Well, I think we typically have been investing in 5 to 10 companies out of their batches. I think this one, like I said, will probably do somewhere between 7 to 10 companies.
Yeah.
I mean, they run a great program. There's some amazing companies there. Occasionally, they're a little expensive, so we have to make decisions about what's right for us. But PG's run a fantastic program. I think Sam is really going to do an excellent job, and he's a tremendous competitor. I think he's going to challenge us to be better, and we're going to try and do that too.
All right, cool. Well, Daniel, thanks for following Dave's Twitter stream apparently and monitoring that for us. Let's see, we've got about 12 minutes left. Let's see if we can get these all in. So, this is from Samir. How is seed financing different than a Series A? What happens to seed financing when a Series A funding comes through? So
Sure.
You probably go through this 100 times a week.
So it depends on what we're talking about seed financing. So it could be that it was a price round seed financing. It could be that it's convertible debt, which might have some cap. It might have an interest rate. It might have a discount. Could be convertible equity, which might not have any interest rate or any maturity point.
What are you seeing right now? Mostly convertible debt or a lot of price rounds?
For rounds
seed?
of under $1 million, usually we see convertible debt with a cap. We are starting to see more convertible equity, and that's actually our preference these days. We actually feel like that's easier to manage. There's less stuff to worry about if a note matures and having to re-extend that note.
Okay.
In a lot of cases, the interest that's being earned, we actually may have to pay tax on phantom interest that we don't ever receive, and a lot of those companies may not actually happen, so the interest rate isn't always beneficial.
Yeah. It's more of a hassle than it's even worth.
Yeah. I think there's a term that we want to include usually, which is if the company sells prior to an institutional round of $1 million or more, then we'd like to see a 2x return on our investment. And the reason we ask for that is because a lot of times companies will sell for anywhere between $5 to $10 million. Founders will actually get pretty substantial paydays, sometimes $1 to $5 million. Sometimes they'll get retention bonuses that investors don't share in. And a lot of times we've ended up getting our principal back, maybe with interest. And that's not really the game that we're in.
Yeah.
And obviously, if the company is only acquired for pennies on the dollar, or there's not really a huge outcome, we know we're probably not going to get that 2x. But there's a lot of times as small investors and for small outcomes, acquirers tend to basically want to cut investors out of the equation as much as possible and push as much of the compensation towards the founders or employees. We know that's going to happen, but in at least small outcomes that are not so small, we would like to participate in some of that upside.
So you say, like, if the acquisition is more than $5 million or some number, right, then we'd like 2x back. Is that what you're saying?
Well, the reality is the acquirers are never going to let a substantial amount of the dollars go to only the investors. They would either nix the deal or just, change the terms.
Right.
So it's really more just a starting point for the negotiation.
Okay.
But occasionally we'll see scenarios where the company's really only sold 20 to 30% of the equity. Founders may get $1 million paydays, and it's really kind of irksome when you know that the total package might be between $3 to $10 million, and you're getting 1x back on that. The other issue is that a lot of times people are pushing up the valuations and caps very high, and so a lot of times, and this has happened with YC demo days, a lot of companies are raising at $10, $12 million caps. Companies that haven't hit $1 million run rate are raising at more than $10 million valuations. And if it's an institutional lead, that's one thing. And if people are jumping in on the board and kind of there is structure for the future,
right.
I think there's less chance of the company just selling for a small amount and the founders keeping a lot of the equity. So in institutional rounds, there are board structure and other protections in the rights that prevent founders running away with a bunch of capital. In smaller seed rounds and convertible debt in particular, there's not really any of those protections,
right.
and you're really trusting the founder to not screw you over, except that the acquirers are intentionally trying to screw you over.
Yeah.
And a lot of founders just don't have very much experience or don't feel like they're in a position of strength to negotiate on that.
No, I've been in that seat, and it's awkward because you might be very low on cash, right? You're running out of money and you want to do something, and everybody knows what the situation is, and so the acquirer is basically saying, well, the only way this is going to work is if we wipe out all those investors, and it's like, you really want me to piss off like my 12 angels who are Dave McClure and Chris Sacca and whoever else?
Well, and they may say, yeah, fuck them.
Yeah,
right?
exactly.
That happens sometimes too.
Yeah.
And obviously, if it's a very small acquisition, if the company's raised $3 million in capital and it's only being acquired for $1 million, then I don't think anybody has the right to ask for 2x in that scenario.
Right.
Some people still do. But it's more the case when we see deals where, okay, it's $5 million to the investors, who have put $5 million in, but then there's a retention package of another $5 million or $10 million, and well, really the entire package is now looking like 10 or 15 million, and you're getting 1x or something back, and I don't know. It's an ongoing conversation to figure out. I think for larger investors, ultimately we don't really care so much. I think we are really kind of playing for the larger outcomes.
Yeah.
But there are a lot of small investors in the Valley who don't have a lot of experience, don't have a lot of portfolio diversification. And I just really, having been that person before, I don't think it's really right for founders to not reward early investors, at least if they're getting manageable sort of outcomes.
Yeah.
All the rest of that aside, I think, usually what happens, convertible debt or convertible equity, it rolls into a priced round. Hopefully you get a decent bump up on the valuation, and you can kind of use that initial seed capital to build the company to, a more significant valuation before you take a large amount of dilution.
All right. Samir, I hope that helps. Let's go to this one from Tessa. What services do you provide your investments after you invest? With so many companies, how can you keep track? It's a great question.
Two different questions.
Yeah.
How do you keep track? The answer is we don't keep track of everything. And the main focus is really to keep track of the things that are working, if possible. In terms of what services or benefits we offer, one of the biggest benefits is just access to a very large network of founders. So really one of the things we're trying to build is a community of peers who can provide information, mentorship, just a reference point. And in that case, there's really a network effects game going on where the more companies that are in, there's actually more value in having access to that large portfolio. In terms of things that we try and provide directly, probably the biggest one we're really working a lot on is distribution and customer acquisition. We have a team that we call the distro team. That's about 6 people right now. We're trying to grow that to probably 10 to 15 people by the end of the year. Some of those services we give away to free for our portfolio, primarily for the accelerator companies. Some of them we offer on a consulting basis to other portfolio companies. We really think that that's a critical component of what we're trying to do, helping companies scale up, mostly via online platforms, search, social, and mobile. We're starting to look at ways that we can do what we call distro financing, where we invest maybe $100,000 to $150,000, maybe take $50,000 of that back on the consulting services side. So really give people the cash to be able to pay for that consulting and then still have some extra cash left over.
Cool. Well, I think we got time for one more. This one is from Francisco. You wrote that you wanted to be thought of as a late bloomer. Did you write that?
I didn't think I wanted to be thought of a late bloomer. I just said I was.
Okay, all right. So
hopefully.
I'm also a late bloomer. What advice do you have that could help me live up to my potential?
Wow.
That's a big question there. Francisco needs some help. So
yeah, I mean, I think that I wrote that piece, when I was in my early 40s and really wasn't feeling so. I guess I was reflecting back on a period maybe 5 years ago when I was in my early 40s and I didn't really feel like I had hit the mark on a lot of things, and it was really tough when you're kind of been in the valley for maybe 20 years and you don't really feel like you haven't built that $1 billion company or even a $100 billion company, and I think it's just tough kind of looking at expectations and maybe not always measuring up to that. It's a tough story for people to kind of figure out and face, the reality of the situation you're in, as well as trying to maintain, ambition and incentive to do some, hopefully meaningful things. I think I've been fortunate in that in the last 5 to 10 years, some things finally started working. And so that's why I wrote that piece. But I think it's really challenging in the Valley with so many talented people and so many young talented people. Yeah. And you're not always lucky. You're not always the one that's going to, get that big win. So I think you got to keep plugging away at it, and you got to just keep motivating yourself and keep trying.
Cool. Well, Francisco, hopefully that helps. I think what I tell people who ask me similar questions is just, find out what you love to do. And if you find something you love to do, usually that's more incentive to keep doing it, right? Because it's not like a job or,
We have to be passionate about the things that we do, particularly with startups. I think because most things fail, you might as well be passionate about what you're doing because you may not make a lot of money at it.
Yeah, exactly. No, startups are hard, and I think a lot of people forget the dark times when you're sitting there thinking about oh man, why am I banging my head against the wall and doing this? So
there's a lot of those.
Yeah, that's a hard situation. This earpiece is driving me nuts. In any event, Dave, we're out of time. Thanks so much for being here and being such a great guest. Anytime. You can follow Dave on Twitter. His handle is @Dave McClure, and you can also follow @500Startups if you feel so inclined. Tune in next week for another episode of FounderLine. Our guest will be Bill Trenchard, who is a partner at First Round Capital. Awesome. And Bill's a great guy. Bill and I competed against each other back in what we call the Calendar Wars when I was at WEN and he was at Jump Networks. He's founded a bunch of companies, Jump, which sold to Microsoft, and LiveOps. He's invested in a bunch as well. Uber and Ironport and Lending Club and Tapulous, and I'm sure it'll be a great show. That's next Wednesday, 5 o'clock Pacific time. Thank you once again to our fantastic sponsors, Oric, Square One Bank, Accretive Solutions, and Ustream. Please follow us on Twitter. Our handle is @FounderLine. You can tweet or email questions ahead of time if you want for Bill to help@founderline.com. And you can go to our website where you can get email updates from us. You can check out all the previous episodes. You can read about the upcoming guests, and you can also subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.